So in our last class, we said that the first one is discounted cash flow method. Number two, we are going to look at the PE ratio method, which we are going to do today. Number three, we shall look at earning yield method. Number four, dividend yield method. So those are the ones that we agree that we shall look at. And of course, I'm assuming that you still remember what discounted cash flow method is. We looked at that example, didn't we? Discounted cash flow method. We looked at general inflation on that scenario. So under this, maybe what we can look at is another question in May 2016. Let me share that one. May 2016. This one is 2018. So we need to look at 2016 May question number 4. So question number 4, somebody has joined. Let me mute. Now, this is the question that we're looking at. It says that Huge Limited intends to take over Tiny Limited, another company in the same industry. Is it the same as what we did the other time? Ziko sawa? Na ile ya last sitting. Hii swali ni sawa na ile, si ndio? Okay. Huge Limited intends to take over a Tiny Limited, another company in the same industry. Tiny Limited is expected to post earnings of 86 million next year. This one is 2016 May 2016 question number 2. May 2016 question number 4. May 2016 question number 4. So if Huge Limited acquires Tiny Limited, the expected results of Tiny Limited for the next 3 years will be as follows. So we have there, I'm hoping that you can do this. We did the one for last sitting, and you can still remember how it was done. Last sitting, they brought the same one, which we were able to look at. So we are told that these are the cash flows, the cost of operations, capital allowances, which are the same as depreciations. We have interest. We have cash to replace the assets and financing at the finance plot. Then they are saying that from year 4 onwards, it is expected that the cash flows from Tiny Limited will increase by 4% each year into perpetuity. So what are we saying here? You look at this thing. We are told that there is year 1, year 2, year 3, which you can be able to calculate the cash flows. Are we together? You can be able to calculate cash flows for year 1, year 2, year 3. But we are told that now from year 4, these are the cash flows in Tiny Limited. Just a minute. Just a minute. What we are saying here, for those who are joining now, Winnie and Edwin, in our previous class, we were looking at how you can value a target company, meaning that if a company has to be acquired by another one, they need to reevaluate and ask themselves, is it worth? So they look at the value of the company they want to acquire. And so we looked at the methods of acquiring the company, the methods of valuing a company before you acquire it. And these are the formulas that we mentioned. Now, this one, they are setting this question where they're going to use the concept of discounted cash flow and mergers, meaning that you need to look at the value of the company in accordance with the cash flows that will come out of it. So unaangalia unasema hii nikinunua sahihi, at the next 5 years I can get this money. So it is what I buy it. That is the connection. So you need to know the value. But how do you know the value? You need to know the benefit you're going to get from it. That is discounted cash flow method. Now, so we are looking at some of the cash flows that we expect from Tiny Limited because we are about to acquire it. We are about to acquire Tiny Limited. We are told that the first 3 are given, but from year 4, there is cash flows that are into perpetuity. From year 4 onwards, it is expected that the cash flows from Tiny Limited will increase by 4% into perpetuity. So that means that year 4 upward, you cannot know the exact amount unless you calculate. The question says that tax is paid at the rate of 30%, and this tax is paid in the same year the profits to which it relates to are earned. Now, when you talk about cash being paid at 30% in the year to which the profits entitled to it or earned are related to, what does that mean? Ordinarily, in our Kenyan setup, our corporate tax we pay in arrears. Mwaka inaisha, we pay in arrears. Mwaka inaisha, and then the following year you pay. Tunaelewana? Lakini in this one, they want to make your life easy. They are telling you that the tax you pay in the same year. All right? So you collect all the revenue for that year, you pay tax on that year in the same year, not in arrears. Sio baadaye. So you need to know the differences. And we have done that in our topic number 1, capital budgeting. We looked at how you can pay tax in arrears, right? I hope that you revised that. If Huge Limited acquires Tiny Limited, it estimates that the gearing after the acquisition will be 35% measured as the value of the debt as a proportion of the total equity and debt. So what is the total equity and debt? What does that mean? They are telling you that gearing is going to be given at 35% of the total equity and debt. So what is total equity and debt? Can somebody tell me? When they tell you that it is a proportion of total equity and debt, can somebody tell me? Leah, Mary, and Jill, Mercy, can you guys tell me? Can you tell me what is the meaning of total equity and debt? Liver Farm, thank you so much. Another person tell me the meaning of total equity and debt. They are telling you that the debt is going to be 30%, 35%, which is the proportion of total equity and debt. So what is total equity and debt in this question? Thank you so much, Ruth. Another person to try. I want to see if you have a different understanding from this. Look at what the examiner says. They are saying that if Huge Limited acquires Tiny Limited, it estimates that the gearing after the acquisition will be 35%, measured. How did they arrive at 35%? They measure it as the value of debt. That is the value of debt as a proportion of the total equity and debt. And after the acquisition of Tiny Limited, Huge Limited would have a cost of debt of 7.4 before tax and a beta of 1.6. The first thing that I want you to tell me is the meaning of total equity and debt. When you have debt plus equity, what does that mean, Ruth? Debt and equity. Hiyo ni nini? What is this? The value of the firm. Thank you. Value of the firm. So you are told that 35% is as a proportion of the value of debt to value of the firm. In other words, they're giving you the weight of debt. Weight of debt will be 35% of the value of the firm. So it is debt all over equity and debt. It is a proportion. So that is basically the weight. Weight of debt. Because they are giving you the weight of debt, but in a clever way. With so much kisungu, but don't worry. Is that simple? The way I can see, Milka is getting it. We can now proceed. They are basically giving you the weight of debt, 35%. They have given you the cost of debt, and they have given you better. So these guys are wishing you well. These are very nice people. So the examiner has decided to give you the weight of debt, which is W, D, to be 35%. The examiner has given you the KD. Is it before tax? To be 7.4%. I hope you know what it means. And then we have debt, beta to be 1.60. You know, this one, which kind of beta is this? Which beta equity is this? Is it beta of a levered firm or unlevered firm? This beta. Is it B, EU, or BE? Is it BU or BL? Beta of levered firm or beta of unlevered firm? Unajua ukisoma hii kitu inafaa unaelewa step by step. Levered firm. Thank you. Because we have been told that after acquisition, the structure will be levered. And in that structure, the levered firm, that firm will now have a beta. If that firm is already levered with a 35% cost weight of debt, then they are telling you that that firm will have a beta. Beta is only the risk on equity, right? So that risk is on equity on a levered firm. Sasa, and it can help you now get the cost of equity of levered firm. Thank you so much. So with this kind of information, this guy is trying to tell you that now we can easily get work, right? Because we know weight of equity can be now the opposite of this. That is how much? 65. And with beta, you can look for information as we proceed and get the KE. Definitely with beta, they're trying to tell you get cost of equity of levered firm using which formula? You can use KASNEB, the KASNEB formula, and talk about RF plus ERM minus RF beta, beta of liver farm. So you can get KE. Ukiwa na KE na uko na weight zote, so you can easily get what? But let's see if that information can be enough and see what the examiner is asking. And you see, and again, I need to understand the question. Wakati unasoma unajaribu kujiuliza, with this information, which direction am I heading to? The kind of this question might end up asking you to calculate work. So they have given you KE. That work is the cost of capital that you can use to discount. Tunaelewana? It is the same cost of capital that you can now use to discount and get the value of the farm. So wanaanzia huku mbali so that they can test if you really understand what we're doing. So let's proceed. Sorry, those who are having network problems, sorry for that. So the risk-free rate is given as 6% and the return on the market portfolio. Return in the market is the same as expected return in the market, which is ERM. So. They want you to calculate the offer price of Tiny Limited if Huge Limited were to value Tiny Limited on a forward price earning multiple of times. Forward planning multiple of times. That is forward price earning. Price earning is the PE ratio that you can use to calculate the value of the firm. Kumbuka, we talked about different ways of calculating the value of the firm. The first one we said you can use discounted cash flow. In the first question here, they are asking you now to use PE ratio with 8 times. So they want to calculate the PE ratio of 8 times. Now, just before we proceed on that, PE ratio, you need to remind yourself how it works. I explained this one earlier. I say that PE is the same as price and earnings. So that means that the market price, this one is the same as the market price per share and earnings per share. PE should be the same as APS all over EPS. MPS over should be the same as MPS all over EPS. Sio tulisoma hivyo. They mean the same thing. So we have learned about that. You remember? So that means that PE ratio, you can get it if you are given the market price per share and earning per share as well, you can get that. And just before we proceed, to make it easier for you, if you are given something, for example, you are told that the number of shares is like 20 million, and you're told that the EPS is like 2, number of shares 20 million, EPS is like 2, then PE ratio you are given as PE ratio is given like 8. Can you calculate the value of the company or the value of the company in the market, which is the same as market value? So market value is just this one here. But now this one is for 1 share. This one is for 1 share. That is why we call it MPS, market price for 1 share. Now the total value is now the market price per share times number of shares, which you have been given here. So what you simply know, you need to know that what is the value of 1 share in the market? You can use this formula because you have this here, and now you have this here, and you have this. So you can use this formula to get your market value of the shares. For 1 share, then you multiply with the number of shares. In that way, you will be getting the total market value of the company. So in this case, we simply say that now since PE is equal to MPS all over EPS, then we are having 8 is equal to MPS, which we don't know, all over 2. Then you have 16 is equal to MPS. So from here, you can easily calculate that. So what is the value? That is for one share. Times number of shares, you say that total value is value of the firm. 16 now times 20M. You're going to have 320M. That is how you can use PE ratio. That is how you can use PE ratio to calculate. You can use the PE ratio to calculate the value of the company. That is PE ratio to calculate the value of the company. Now, using this concept, can you understand what the examiner is now setting when they are now using or they are now merging or including the mergers and acquisition? Under mergers and acquisition, we were looking at a question. I hope that this concept imeingia. That's simple. Now look at what the examiner is saying. When the examiner says that they have given you a PE ratio of 8 times, hata hapa nimekupea 8 times, you can now easily get the value of the company. But let's now proceed. The next question is saying that the weighted cost of capital, which you can get, you can get work. And now use that work to calculate the discounted cash flow. Sindio, that is what the examiner expects based on valuation. That is DCF, discounted cash flow, using the work. That is why you are calculating work kwanza, ndio sasa ukuje discount. Okay? So here, where do we start from? Who can guide me? What you think we can do first? Who can tell me where you can start from in that question? Assuming that you're doing that question in exam. To solve the first question. Who can help me? Anything that you can do. In exams, just try to put something down. Just write something down. That thing might be 2 marks or even 1. That could be the marks that you require to pass exams. Where can you start from that you think is very easy for you? Of course, cash flows will help you discount. So before you reach there or you arrive at that position where you discount, utaanzia wapi so that you can solve the first question? Ruth, ungeanzia wapi? Where would you start from if you are in exams? So that you solve the first question, what would you do? Huh? Let me see, Topista. What will you do? Get the cost of equity. Thank you so much. Yes, that is a mark. Just getting the cost of equity is already a mark. But remember, we want to solve the first question. We want to calculate the PE ratio, value of the company using PE ratio. Utafanya nini? So that was question is 20 November, May 2016, question number 4. So the first thing that you should do, that is number 1 or Roman 1, is to get the PE ratio, which is equal to MPS or over EPS, right? And the PE ratio, we've been told that PE is equal to 8 times. What you're looking at, what you're targeting is MPS. This MPS is what is going to give you the value of the company. So you need to ask yourself, now that I have this, how do I get EPS so that I can get MPS? Right? What is the market value of the company? This one is also the same as total value all over total earnings. This one is value, market value. All over total earnings. Hii ni per share na hii pia ni per share. If you make it total, we now have this one total and this one is total. So total earnings unajua. It is only that here we are saying earning per share for one share. Lakini sasa hapa tunasema total earnings. The same thing. Hapa ni total market value, but hapa ni market value for one share, market value per share, MPS. Sasa, so inakuwa rahisi hivi. Look at that now. Make the total market value become the circular formula. So you say that total value is equal to P ratio times total earnings. Are you given that? Is now 8 times 86. Kwani hii pia ni kitu ya kustuka? Is this something that can scare you guys? Yani earnings wamekupea ndio hii. They are saying that Tiny Limited is expected to post earning of 86 million next year. What are you getting? The value of the company using PE. Thank you so much, Jen. Who is getting me the figure? Isn't it easy? So we're going to have 688 million. We are done with the first part of the question. I don't know if it is Roman 1 or A. It was that simple. The second part of the question, that was Roman 1. The second question is to calculate work. Work. So work you can calculate using the information that we have here. So our KEL is equal to, what is RF? We have 6 and then 11. So we have 6 plus 11 minus 6, all over 1.6. What are we getting there? Now what? With this kind of information, everything now seems to be easy. Can you guys calculate work and get me the answer? Calculate for me one. Are we getting 11%? All of us. 10 point. So you're saying that work is equal to so you have to have, that was after, that was before. What you are given is the cost of debt before tax. So you have to subtract tax. So we have rate. So that is what we are getting. Now we have work. We have sorted Roman, the second question, or Roman number 2. Roman number 2 wanted you to calculate work. The last one, the offer price of Tiny Limited, using a discounted cash flow based valuation. So we need to know the discounted cash flow. We need to calculate the NPV, right? This discounted cash flow is basically NPV. And in NPV, we need to get the cash flows. The cash flows that we are given are there. Look at the cash flows that we are given. So we can have our sales. Year 1, we are given there. Yeah, year 1. So year 1, we are having 20 million. Year 2, we are having 2. $28. Then we have the 20 year 3. Cash cost of expenses. We have 120. We need to be subtracted. We have 160. It's 28. It's 200. Then we have 180. The next one, we have capital allowances. Right? So those are the expenses that we normally have in our normal operation. So can we now get our amount that can be taxed? Cash to replace the asset is not part of the normal operation expenses. So we don't include it. So can we subtract and get our taxable amount? Idea tax to replace asset is like a saving. So you save that amount. It is not an expense. It's not an expense. So get with this one. So cash to replace asset, you normally deduct it. It is like a saving, you deduct it after tax. This one, unaitoa after tax because it is not part of the operation expenses. So we have 25, 30, and 35. This is now what we call free cash flow. Free cash flow. It is now the cash flow that you are free, you can use the way you want. Free cash flow. It is the amount that you can discount, this one. So tell me when you are done with this. Kama ushafika hapo niambie niendelee. Can we proceed? So we have agreed that other discounted cash flow, what should worry you is how to get the cash flows. So you can use this method to get the cash flows. In discounted cash flow method, you'll end up getting NPV. So you need the cash flow and then you need the discounting rate. Now, we have done it up to this point. We have cash flow for year 1, year 2, and year 3. How can we get this one? How can we get this one? Which formula do we use? Which formula do we use? Professor, which formula do we use? Mercy, which formula? You remember this formula called Gordon's formula? Gordon's formula for growth rate, which says that P is equal to P. Do we remember that formula? Is it like that? Or this one should be here? Where should it be? Whenever you are given, sorry, whenever you are given revenues that are moving into perpetuity, use the Gordon's formula to get the value here. Anytime you're told there is a constant growth rate and it is moving into perpetuity, use Gordon's formula to get that constant. So here, the last one that we know is 68. So this one shall have our 68 to 1 plus G. What is G? Growth rate. We are trying to get cash flow for year 4 going forward. So our growth rate is 4%. Yes, from year 4 onwards, from 4 onward, it is expected that the annual cash flows of Tiny Limited will increase at the rate of 4% into perpetuity. So we have 4%. And here, what do you get? Tell me what you're getting. So you're getting 10. Which one is correct now? Who is correct? Can you calculate and get me the correct figure here? Then now get the discounting factors for year one. Year two, year three. Get me discounting factors. Thank you so much, bro. Get me discounting factors. Discounting factors for year one, year two, and year three. Which one do you use here? The third year. So you use the one for the last year that you're seeing. Take me the present values, present values. What value are you getting there? And we add them. What are you getting there as the value? Are these figures correct? This one. Okay. Add them now. So that is how you can be able to do it. Is there any person who has a challenge, any problem in calculating that? You can now try the same in 2019. 2019 question number 5. I want you to go and try that. 2019 question number 5. May 2019 question number 5. I want you to go and try this the same way. That one was for 2016, May 2016. May 2016 question number 4 is the one that we have done. So you are supposed to try this. So this one, we didn't have initial outlay. So we are not getting net present value because we don't have initial outlay. The figure that you're going to get here is the value of the pound. Are you seeing some similarities here? Earnings yield method is EPS over MPS, but P ratio is MPS over EPS. So we are dealing with this. Hiyo ni rahisi. Now that you know the formula, you can also equate EPS all over MPS is equal to total earnings, because earnings are basically the EPS but for all the shares. So total earnings all over total value is the same as EPS all over MPS, that ratio. Then you can now come here and say, now you can equate EY, that is earnings L, to total earnings all over total value. You now make the value to be the subject of the formula. Then you say now the value is equal to total earnings all over EY, which is the same as total earning was 20 million, EY is 2. The value of the firm is 10 million. The value of the firm is 10 million. Let's look at the last one and then we can go and sleep. That is dividend yield method. Dividend yield method. So this one, dividend yield is DPS, just the same as EPS. So we have DPS all over MPS. So we have total dividends all over total value, which is the value of the value of the market or market value. So market value of the company is the same as total dividends all over DY. So illustration. Who can try for us this? Who can try for us that? Somebody to try that. I'm giving you some 2 minutes. So what are we supposed to do here? You simply need to know what is retention. If this is retention, you are retaining part of the earnings. So how much did you declare as the dividends? How much is the dividend? Dividend, if you return 40, dividend is now 60% of the earnings, which is giving you 180, right? It's giving you 18 million. So we know now what we have retained, 18 million. What we have paid as dividends, sorry. What we have paid as dividends is 18 million. So therefore, we have our DY, our value is equal to 18M all over 0.8. What are you getting? Unapata this one is the same as 180 still, all over 8. So this one goes here, 2 to 16. Balance is 20, still 20 again, 2. Balance is 4. So it is 5M. The value of the company is 22.5M. Thank you so much. That is the end of today's class. Unless somebody has a question, we are done with that topic. We shall start topic number 5 in our next class. Sawa. Okay, so tomorrow we shall not have a class. You can use that time to read. Those who are not doing FR. Those who are doing FR, you'll be able to attend class, hopefully. The previous question, which year? The first one was 2016. The one we've just done, it is already raining outside here. It's raining cats and dogs. The first question was 2016, question number 4. And then the second one I gave you, 2019, question number 5. On May. On May. So let me go home. It is raining cats and dogs. Let me rush home. We shall meet on Wednesday. I'm assuming that topic number 2 you guys have watched. The tax was not paid in arrears. They said that it's paid in the same year where the income is earned. So you don't have to pay in arrears. Okay, sasa, good night.